Hey guys, welcome back to a brand new video. I'm RexFinance, and today we need to revisit Workhorse stock. It's well overdue. You see, when I first reintroduced Workhorse stock to my portfolio, I mentioned that this was much more of a gamble than an investment, but it had the potential to turn into a long-term investment depending on whether or not the management team could execute. I mentioned, A, I would not hesitate to sell out of my entire 10,000 share position if the management team failed to execute, and B, that I would not hesitate to double my position to 20,000 shares if the management team did execute. So in today's video, I'm going to go over the recent earnings release, the new numbers and new information we got. I'm going to put together a brand new price target and fair value spreadsheet. I'm going to tell you what I've done with my personal position in Workhorse stock. Now, during the month of August, it's been a very rough month. We're down to 75 cents a share, and it was looking really good. Like during the last week of June and throughout the whole month of July, the stock was up over 66%. But it just so happens that the stock topped at $1.33 on July 31st, which is also when the rest of the stock market found its top. And throughout the month of August, this hasn't been company specific to Workhorse. Lots of the risk on or high beta stocks in the market have felt immense pain. Their gains year to date in 2023 have either been cut in half or they've completely disappeared in some cases. So although I do believe that some of this fall from $1.33 down to 75 cents currently is company specific, I do believe that a lot of this actually is just the broad market. But really quick, I want to mention, if you guys are new here or returning and not yet subscribed, please subscribe down below. We're one of the fastest growing stock market YouTube channels currently, and I don't know about you guys, but me personally, I'm biased, but I'd like to continue that trend. Also, comment down below whether or not you think Workhorse is going to make it or they're going to go broke. Risk on and high beta stocks falling throughout the month of August is entirely related and correlated with the fact that treasury yields continue to rise and the markets continue to price in more and more rate hikes and higher rate hikes for longer. But speaking specifically of the company, I believe what hurt the most was the company's earnings release that came out on August 8th, where they announced that they were lowering their year-end revenue guidance to $65 to $85 million. This is down from $75 to $125 million or something like that. So definitely towards the low end of their prior guidance. And we also have the fact that it's literally make or break for the company right now. I either believe this stock is 1,200% undervalued or that it's going bankrupt. I don't think there's any in between. And it all has to do with these two events that are coming up. On August 24th, there's a stockholder Q&A webcast from the management team that's going to take place. And then a few days later, we have a special meeting of stockholders on August 28th. During this special meeting of stockholders, they're going to vote on increasing the authorized share count. Now, let me break this down for you. According to the latest quarterly report, there are currently 205 million shares outstanding and only 250 million shares that are authorized. They actually gave us even more up-to-date information on the current shares outstanding. As of July 10th, we had approximately 210 million shares outstanding. 210 million out of the 250 million that are authorized. And also stack in the fact that the company's going to pay around $20 million in shares of Workhorse stock towards legal settlement. And all of a sudden, it's becoming very apparent that the company's running out of room to raise capital via equity. According to my calculations, the company can raise an additional $15 to $20 million by selling more shares on the open markets, and that is it. Now, a lot of you guys watching this video, specifically if you invest in the company currently, hear that and think, oh, that's really good because that means there's not going to be any more dilution. That's very good. So I'm going to vote against this proposal to raise the authorized share count. However, I'm going to explain my viewpoint with this. I am voting for the proposal to increase the authorized share count. You see, if the company runs out of room to raise additional capital via equity, the only other lever they can pull is debt. And right now, the markets for debt are terrible. Any debt deal that this company could take out currently would be so unattractive that I would sell out of my entire position. They would be paying so much in interest expense on any debt they take out. Now, it sucks. Yes, they're diluting shareholders at less than $1 per share, but that is so much more attractive right now than the debt markets are. And considering that the debt markets are pretty much closed right now, there's not much money coming into electric vehicle startups. This all adds up to either the company needs to increase the authorized share count or they're going to go bankrupt. Maybe the management team won't state that specifically, but I will. It's make or break right now. They need to increase the authorized share count, and as an investor in the company, I believe this is in the best interest of my personal investment here. The company is not profitable currently, and according to my calculations, they won't be profitable until 2025. If they're not profitable, they're burning cash. If they can't raise cash, they're going to run out of cash, and that's how you go bankrupt. Now, this doesn't all have to be doom and gloom. The management team is doing some very, very good things that should contribute to overall profitability, like I stated, for 2025. In the earnings call, they gave us some important information saying that their contribution margin is positive for each electric vehicle that they sell. That means that if they get their quarterly vehicle volumes to about 300 trucks, meaning they deliver and sell 300 trucks per quarter, they expect that they would be able to generate a positive gross margin for the company. Now, positive gross margin does not mean overall profitability, but it's the first step towards it. If you are gross margin positive, it means that each additional vehicle you sell will contribute positively to the bottom line of the company. Gross margin positive just means that the direct costs of producing whatever you're selling are paid for and accounted for. The fixed costs of the company still need to be covered, which is why overall profitability is going to be a matter of scale for the company. The management team goes on to state that they believe they can reach this 300 truck per quarter threshold either in Q4 of this year in 2023 or in Q1 of 2024. Let me be very clear about this. This is not an option. This is a requirement for this company if they want to make it. They need to achieve this gross margin positivity. Now, the bad news with this is they only sold 42 vehicles in Q2. That is a far cry from the 300 number that they just called out in the earnings call, which means there is a lot of scaling up that the company still needs to do. And I mentioned how interest rates have been a drag to the company's stock price, in my opinion, especially this month in August as treasury yields have skyrocketed. But interest rates don't only affect the stock price of the company. You see, the current interest rate environment we're in now, despite all of the federal and state incentives to purchase electric vehicles, is a huge drag on anybody that's looking to purchase electric commercial vehicles. And it's not just electric vehicle manufacturers that are struggling, it's also the legacy auto manufacturers that are struggling. Higher interest rates naturally make it much more difficult to sell vehicles. This means that as a Workhorse shareholder, we really need to pay attention for and root for the federal funds rate to peak and even come down. This is what it would take to see a large boost in sales for the company. Now, the market right now, pretty clearly, based on treasury yields skyrocketing, are pricing in the probability that we will see multiple additional rate hikes and that rates will stay higher for longer. This is not good for a stock like Workhorse, which again is part of the reason the stock has felt pain. However, I personally disagree with what the markets are pricing in. If you want my opinion on this, obviously, I believe that interest rates aren't going to go higher and will not stay high for very long. But for more information, go watch my latest 2 videos where I really break this down. I don't think Jerome Powell has an option. I believe that he has to lower the federal funds rate. Go watch Bears Will Be Wrong Again and the urgent warning to all investors. I'll leave links down below in the description. And then next, this was not a press release, but this is a huge deal for the company. I found this while I was reading through the 10Q SEC filing. On August 10th, the company entered into a floor plan and security agreement with Mitsubishi HC Capital America. Pursuant to this arrangement, the company has obtained a revolving floor plan line of credit with maximum borrowing limit of $5 million. The floor plan line of credit allows the company to finance the acquisition of inventory, which is primarily intended for use in our manufacturing and sales of our W4CC and W750 vehicles. As the inventory is sold, the company is required to repay the borrowings from the proceeds of the sales. The interest rate on this line of credit is the SOFR rate, the secured overnight financing rate, plus 4.86%. I believe this is a very smart move for the company, especially considering the fact that they might not pass this increase in the authorized share count. What this line of credit will do is it will preserve short-term cash spend. It will prevent the short-term cash spend. This is a huge deal for the company trying to maintain its cash balance of $62 million currently. Right now, the balance sheet of this company looks really healthy. $62 million of cash and $9.5 million of debt. But again, we need to remember, this is not an overall profitable company right now. We're not even gross margin positive yet. So because of that, our cash balance is going to naturally go down over time as we burn more cash, and especially if the company can't raise more funds via equity or debt. So this line of credit, again, is going to prevent short-term cash burn. Instead of using existing cash on the company's balance sheet to acquire inventory, they can use this line of credit. However, over the long term, the downside of this is that it introduces interest expense to the company's income statement. Over the short term, very, very good deal. Over the long term, it will hurt the profitability of the company. So based on this line of credit and the company's trajectory to be gross margin positive either in Q4 of this year or Q1 of next year, I still believe that this company is going to make it. I don't think they're going to go bankrupt, especially because I do believe they will pass the increase in the authorized share count. Obviously, the management team believes it's going to be a very, very close vote. Otherwise, they wouldn't be calling you and sending you mail telling you to vote for the proposal. But I do believe, given all of the institutions that are invested, that they will have enough votes to pass this proposal, which I believe is a very, very good thing for long-term investors. Now, moving to my price target spreadsheet, I've made some significant changes here. Because the management team seems to be executing much slower than I envisioned them executing, I have largely decreased the amount of vehicles that the company is going to sell in 2023, in 2024, and in 2025. Obviously, this has resulted in a dramatic decrease in the total revenues of the company. Instead of getting close to $1 billion in sales in 2025, I now believe the company is only going to be around $560 million of sales. But I did make some positive changes as well. I increased the overall gross margin of the vehicles that this company is going to sell over time from 10% this year in 2023 to 15% in 2024 and then to 20% in 2025. And I also added a significant amount of drone revenue for the company. In my opinion, this is the most promising and most exciting part of Workhorse right now is the drone segment. I've added revenues for the drone segment that weren't there according to my last update. And I've also increased the gross margin of the drone business to 30% this year, 32.5% next year, and 35% in 2025. And the benefits did not stop there. I also decreased my estimated operating expenditures for the company this year to $90 million, decreased it for next year to $100 million, and decreased it for 2025 to $110 million. And again, I do believe that in 2025, the company will ink out a very, very small profit of $3.5 million or a penny per share of EPS. So in my opinion, I believe the company is going to grow less fast, but be much more efficient and have much better margins. And I've been saying this, but I believe it's more likely than ever. I do believe that we will see a reverse split in the stock of Workhorse. This is not a bad thing. In fact, this is probably a very, very good thing for the long term of investors. If the company can make it through, we just don't want to see them start this cycle of reverse split, followed with a ton of dilution, which forces another reverse split, followed by a ton of more dilution, which creates another reverse split. We don't want to see that happen. So we really need to keep our eyes on whether or not the company can achieve overall profitability. But what all of this has resulted in is decreased price targets and fair values, in my opinion. For 2023, I now see the fair value of the company being only $1.48. I say only, but that's still 96% upside from current prices, but that price target is down from $2.60. Next year, my price target is down from $10.70 to $5.44, which is still 625% upside. And then my price target for 2025, or my fair value for 2025, went down from $22.81 to $12.33, which still represents 1,500% upside. So as an investor right now, I still think we can see tremendous returns in Workhorse stock over the next few years. If this management team can complete this turnaround, it's just a matter of whether or not they have the balance sheet to do it. I still believe they're going to do it, but I'm not ready to double my share count. The risk is still very, very heavy in this company and in this stock, and I believe there are some better opportunities out there in the stock market. There's too many other good opportunities is the way I should put it in the stock market for me to want to dedicate another $10,000 plus to my position in Workhorse stock. But I'm going to end this video here. Comment down below whether you think this is the opportunity of a lifetime or whether you think this company is going to go bankrupt. Make sure you hit that like button down below, and don't forget to subscribe if you are new here or returning and not yet subscribed. Stay blessed. Keep 10 toes to the ground and your chin up. Peace out.